Your overseas revenue is up 75%. The board is celebrating. But cash has fallen from $8 million to 2 margins no longer reconcile. Local teams are making commitments headquarters cannot see, and tax questions are arriving in 3 different languages. This is not a growth story. It is a control failure, wearing a growth costume. In the next 7 minutes, I will show you the 7 financial traps that can turn a successful global expansion into an expensive retreat. And stay until the end, because I will give you a 1-page test that tells you whether your expansion is financially ready to scale. No accounting lecture, just the questions a CFO should ask before the cash disappears. Let us meet NovaTech. It is a fictional Shenzhen technology company with a great product and ambitious global customers. NovaTech opens operations in Germany, Singapore, and the United States. In 18 months, overseas sales reach $15 million. On the surface, the strategy works. But the German team gives customers 90 days to pay. In the US, business sells in dollars and buys key components in renminbi. Singapore charges management fees nobody can clearly explain. NovaTech has not built one global company, it has built 4 different versions of the truth. Trap 1. Revenue is not economics. Trap number 1. Mistaking revenue for economics. A product shows a 32% gross margin in the sales deck. Great, now add international freight, customs duties, distributor rebates, local technical support, warranty claims, payment fees, and currency movement. That 32% becomes 11. Then one major customer pays 60 days late, and the risk-adjusted return may turn negative. So do not ask only what is the gross margin. Ask, how much cash contribution remains after the full cost of serving this market? Revenue is a headline. Economics is what survives underneath it. Trap 2. The entity follows the sales map. Trap number 2. Opening a foreign company because someone put a pin on a map. A country manager says, we need a local entity, maybe. But that decision changes hiring, banking, tax, reporting, capital, dividends, and how easily you can exit. While approving it, ask 5 questions. Who signs the contracts? Who employs the people? Who owns the inventory? Who carries credit and warranty risk? And how will cash enter and leave the country? A foreign subsidiary is not a registration certificate. It is a permanent operating responsibility. Trap 3. Profit is not cash trap. Number 3. Confusing profit with liquidity. NovaTech wins a $5 million order. It buys components today, manufactures next month, ships after that. The customer accepts the equipment 30 days later and pays 60 days. After acceptance, cash goes out on day 1. Cash may not come back for 150 days. And growth repeats that funding gap on every new order. That is how a profitable subsidiary misses payroll on Friday. The fix is a 13-week cash forecast by legal entity and currency, with actual collection dates, actual payment dates, and a downside case if the forecast says cash runs out in week 7. That is not a reporting result. It is your decision deadline. Trap 4. FX begins before the invoice. Trap number 4. Discovering currency risk after the margin is gone. Must companies start watching foreign exchange when they issue the invoice? But if the customer price was fixed when the contract was signed, the economic exposure started that day, months earlier. Imagine a contract with a 10% operating margin. If the cost currency moves against you by 10%, how much margin is left? Potentially none. In exchange is not about predicting the market. It is about protecting the margin, the business already approved, the exposure from price commitment to cash collection. Then use contract terms, natural offsets, and a disciplined hedge policy to manage it. Trap 5. Transfer pricing exists only in a spreadsheet trap. Number 5. Treating transfer pricing as a December journal entry. A quarters charges every subsidiary a management fee equal to 5% of revenue. The spreadsheet balances, but a tax authority may ask, what service was delivered? Who delivered it? Who benefited? Why was revenue the right allocation key? And where is the evidence? every intercompany charge has 3 stories. The policy says what should happen, the agreement and evidence show what actually happened, the accounting shows what entered the ledger. If those 3 stories do not match, the group has not implemented its policy. SaaS pricing is not a magic percentage, it is a value creation story. Your documents and numbers must prove. Trap 6. Local compliance has no global owner. Trap number 6. Everyone owns a piece of compliance, so nobody owns the whole thing. The local accountant knows a filing date, headquarters knows the group policy, the business team knows what actually happened, but nobody connects all 3. That gap creates missed registrations, unsupported expenses, inconsistent revenue cutoff, and late tax payments. The solution is not one heroic controller working until midnight. It is a visible compliance calendar, with a named preparer, reviewer, evidence, standard, deadline, and escalation owner for every material obligation. If a deadline can fail silently, the control does not exist. Trap 7. Headquarters receives data, not insight. Trap number 7. Headquarters receives 20 spreadsheets, and still does not know what happened. Countries use different charts of accounts, exchange rates, cutoff rules, and definitions of margin. The group report is finished on day 20, when it is already too late to change the month. A global finance function needs one management language, one chart of accounts map, one contribution margin definition, one cash view, one close calendar, and one owner for every exception. COD spreadsheets do not create more truth. They often create more places for truth to disappear. The one-page test. Now take one page and write down these 7 areas. 1. Unit economics by country and channel. 2. Entity structure and the path for cash to move. 3. 13-week cash visibility. 4. Currency exposure by timing and owner. 5. Intercompany policy, evidence, and accounting. 6. Compliance calendar and accountability. Score each one green, amber, or red. Green means the process is defined, owned, evidenced, and working. Amber means it works through manual effort or key person dependency. Red means the group cannot reliably see or control the risk. If 2 or more areas are red, do not automatically stop the expansion, but do not accelerate it until the finance system catches up. 7-day action plan. Here are 3 actions for the next 7 days. First, recalculate one major overseas contract using the full landed cost and cost to serve. Second, draw every overseas entity and every material cash flow on a single page. Third, ask each country leader for expected cash, not profit, for the next 13 weeks. Those 3 steps will reveal more than another month of management reports. Close and next episode loop. Which of the 7 traps is most dangerous in your business right now? Put the number in the comments 1 through 7 and tell me the country you are expanding into. In the next episode, we will answer the decision that shapes almost everything else: distributor, branch, or subsidiary, because opening a foreign company can take weeks. Unwinding the wrong one can take years. Subscribe, and I will see you in the next Global CFO Playbook.